This is the most recent happening. A U.S. Navy guided missile destroyer fired on an Iranian cargo ship called Tuska because it's claimed that the ship failed to comply with repeated warnings over a 6-hour period. Trump commented that the Iranian crew refused to listen despite U.S. warning them to stop. That's why the U.S. Navy blew a hole in the engine room of the Tuska ship. Also, that ship is under U.S. Treasury sanctions due to prior history of illegal activities. The reason of this attack is from the escalation of the blockade, and Iran fired upon commercial vessels that attempted to transit between the Strait of Hormuz prior to the U.S. Navy's attack. So then, the next item is U.S. and Iran representatives were supposed to meet in Pakistan again for the second round of peace negotiations. But it said that Iran canceled that and said that the ongoing blockade is a breach of the ceasefire between U.S. And lastly, Trump said if Iran didn't agree with the U.S. terms to end the conflict, he would knock out every single power plant and breach in Iran. Amongst the 3 biggest economies, U.S., Euro area, and China, the one that's experiencing the greatest impact from Iran war is Eurozone. Industrial production was already sluggish before the Middle East war. At the start of this year, it's already not encouraging because the front-loading by American businesses eased. So then, production levels dropped. For some background, when Trump's tariffs rolled out, most American businesses front-loaded their orders. Then as time goes by, this front-loading naturally eased. Eurozone's April industrial production expectedly nosedived, dropping by 2.4% month-on-month. But year-on-year, it's at 0.8%. Ireland experienced a drop of more than 15%. A very steep drop, and then the big economies, Germany, the biggest GDP carrier, France, and then Spain, all experienced industrial productions drop. But for Italy, it recorded some improvements. Well, fortunately or not, look at the stats at the right. Eurozone industrial production accounts for about a quarter of the total value add to economy growth. Some might say this isn't a lot, but some also say it's quite a strong pillar, being 24.2%. Looking forward, Eurozone manufacturing sector is currently and will continue to be highly sensitive to these 2 factors. Firstly, Trump's tariffs, which affect the cyclical turning of inventory cycle. Businesses responded to the tariffs with front-loading orders. That front load was the main driver for the surge in industrial productions and no other organic reasons. The next factor is energy prices. Most Eurozone manufacturers consume a lot of power. Hence, swings in power and gas prices will feed directly into production costs. And then Europe tends to be a net importer of energy, and they depend quite a fair bit on external energy supplies. Moving on to China, GDP of Q1 2026 grew at 5%. Robust exports offset the sluggish domestic consumption, but the energy shock from Iran war threatens the forward-looking momentum. Looking at March, retail sales dropped year-on-year. It grew 1.7%. Coming off the January and February holiday season high. And then this is more prominent. Auto sales dropped 11.8% year-on-year. This is showing that Chinese consumers are still very cautious towards spending on big-ticket items. Furniture sales also dropped quite a fair bit, and that's also considered as a big-ticket items. Industrial output also slowed, but not a lot, currently at 5.7%. China tends to look at January and February together to smoothen out the outlier holiday seasons. In that period, exports grew 21.8%. March's exports dropped to a growth of 2.5% year-on-year. The main reason is because of high energy prices from the U.S.-Iran war, which feeds into higher logistic costs. And urban fixed asset investment, which includes real estate and infrastructure in China, grew 1.7% when you compare from last year's Q1 to this year's. And then, real estate. The downturn persists. Investments in real estate fell 11.2%. The previous number was a drop of 9.9%. It worsened more this time around. But nonetheless, in total, GDP is still well. The recent oil shock is already slowing trade and pushing factory prices up. The most recent PPI went higher, but the beauty of China is not only are they sitting on big oil reserve, but also oil shipments that head to China through the Strait of Hormuz account for only 6.6% of China's total energy consumption. That's far lower than other Asian countries, and because China is still using coal for energy production. And lastly, Statistics Bureau commented that the oil price increase doesn't have a major impact so far, but nonetheless hoped for the situation to stabilize soon. On to Singapore. Recently, in mid-April, the Monetary Authority of Singapore increased the slope of SGP policy band, the first tightening since 2021-2022. The main reason for raising the Sing dollar is higher prices, inflation. On top of U.S. tariffs, oil and LNG prices both surged because of the U.S. and Iran conflict. And the impact on Singapore's economy is immediate. Natural gas accounts for 94% of energy generation. With Qatar supplying approximately 47% of seaborne LNG, that means any disruption at the Strait of Hormuz has high impact on Singapore. And energy costs make up to 76% of the regulated electricity tariff. The full impact hasn't fully flowed through yet. It'll happen by Q3 this year, and the central bank revised the core inflation forecast to 1.5% to 2.5%. They're expecting higher inflation, which is why they steepen the SGD appreciation path, making Sing dollar appreciate higher, using currency as a direct offset to the imported price pressure. So what is Singapore dollar nominal effective exchange rate? It's the value of Sing dollar against a trade-weighted basket of currencies from major trading partners, and Monetary Authority of Singapore uses it as the main tool to manage levels of inflation, which ensures medium-term price stability because Singapore is a very small and trade-reliant economy. Usually, most central banks will maneuver their respective interest rates to combat inflation, but not for Singapore. Here's the two main reasons. First, gross exports and imports of goods and services sum up to more than 3 times of Singapore's GDP. That means exchange rates has high influence on inflation levels compared to interest rates. Second, because of Singapore's well-structured system for setting up of businesses with relatively lower corporate tax, Singapore is a good place for businesses to park their headquarters here. But many large firms in Singapore, especially the multinationals, often fund themselves through parent companies elsewhere, often in other currencies, rather than borrowing locally. So the impact of tweaking interest rates won't really change much, but it's more effective to change exchange rates. There are benefits from Sing dollar's appreciation. It's very common that whenever there's geopolitical risks, capital typically look for safer places. Alongside returns, they also want to preserve. For Singapore's case, the Sing dollar tightening is a managed appreciation. This will bring more capital inflow instead of outflow. The currency appreciation will enhance the total returns of investments. And it's anchored by policy, not market volatility, not a drop in confidence levels. This creates a destination for global capital and improved entry point into Singapore assets, where currency gains will compound the underlying returns. Furthermore, the proposition stays consistent. Singapore's political stability, legal clarity, and no capital gains tax. Wealth inflows are already translating into earnings. Fee income grew 18% at DBS and 22% at OCBC in 2025, driven by wealth management activity. That means more money is flowing into Singapore, and the stronger Sing dollar will stabilize net interest margins across floating rate loans. Because previously the SORA was lowered, which reduced interest margins. But now the currency gains will pull it up, hence stabilizing the net interest margins. But not all is good. The same thing that supports bank is a headwind for Singapore REITs. It's already visible in the market pricing. ST REIT index already dropped 4.1% year-to-date in mid-April, and the 10-year Singapore government securities yield increased to around 2%. So basically, this risk-free instrument is already providing a higher yield now, which compressed the yield of real estate and REIT, making them less attractive. So on to the forward-looking enhancements. Equity Market Development Program has expanded to $6.5 billion. This is meant to grow the landscape for Singapore equity market. There are many initiatives, and a big one is the upcoming Singapore Exchange to NASDAQ dual listing bridge. Many entrepreneurs in Singapore prefer to list their business in NASDAQ instead of SGX because of more market liquidity, more transaction activities, more deals as well. This dual listing bridge will improve market liquidity. That means deeper capital pools, stronger investor engagement, and a better investable market structure. Now, all of this will enhance Singapore-listed companies' valuations. So the conclusion is the tightening of monetary policy is a good thing. The main purpose is to fight inflation. And as a result, the stronger Sing dollar will attract more capital inflow into Singapore rather than a constraint on equities.